Hello, this video is about accounting controls in business. What are accounting controls? Accounting controls are an entity's procedures and methods for ensuring the assurance, validity, and accuracy of its financial statements. Still, these controls are applied to ensure compliance, safeguard the company, and comply with taxes, rules, and regulations. There are various types of control applied within an organization. How do accounting controls work? Accounting controls are the measures and controls adopted by an organization to increase efficiency and compliance and ensure that financial statements are accurate when presented to auditors, bankers, investors, and other stakeholders. Internal accounting controls are not developed now. These have existed in place for decades. This also makes it a compulsion for organizations to follow corporate disclosure, guidelines, and other requirements. The point is that accounting controls are an integrated part of any organization nowadays. Without them, the accounting system is like a car without brakes, and no one wants to ride in such a car. So, any organization that aspires to grow big and better must have robust accounting controls. There are three major categories of accounting internal controls. Detective controls. As the name suggests, these controls are in place to discover discrepancies and deviations from the policies. It also serves the purpose of the integrity check. Accounting controls for cash are examples that can be cited here. For example, a surprise check of the cash balance in hand with the cashier and cash balance as per accounts will ensure whether the cashier is doing his job accurately or not. It might also reflect any accounting posting error. In a computerized environment where the numbers are huge in volume and end-to-end processing of accounts is done by the system. In those cases, we might want to put a test invoice and track till accounts finalization to see if it gives the desired result and it is compliant to regulations. In the same way, comparing the raw physical stock in the warehouse to the closing stock in the box will show difference in inventory, processing, and discrepancy or usual loss. Also ensuring that all the assets showing in the books are physically available ensures the safety of assets. For example, we have understood that detective controls are applied irregularly and are more of an audit nature to identify errors or discrepancies. Preventive controls. The controls are applied daily within the organization to prevent errors or discrepancies from occurring. These are the rules that everyone within the organization must abide by in their day-to-day jobs. For example, in the accounting environment, when a person books an invoice, it goes to another person to peer review and approval. Once the invoice is accounted for, another team makes the payment. This is called segregation of duties, ensuring one person does not have control of booking and paying invoices daily. Job rotation is a classic example of preventive control. In a big organization or at a critical place, personnel are transferred regularly to ensure that no person has access to any data or asset for an extended period, which prevents the person from getting involved in thefts or illegal activities. In a computerized environment, storing the data daily on the cloud is also a safety control to avoid data loss. Corrective controls. These controls come to the rescue when preventive and detective controls have failed to avoid an error. In an accounting environment, posting an adjustment or rectification entry is an example of corrective controls. Once the books are closed after the financial year and the auditors find an issue to be addressed, reopening the financial year books and making the adjustments an auditor asks for is also a part of corrective control. In this case, the trial balance still agrees, and later on verification of ledgers, this error was identified. For example, while posting a journal entry, the accountant debited Mr. Tom instead of Mr. Robert for $500. The rectification entry is to debit Mr. Robert and credit Mr. Tom by $500. It is called corrective control. Examples. Let us understand the accounting controls definition better from the examples given below. Segregation of duties. Processor and approver should be two different people. An independent user ID and password should be provided to all the employees. Physical verification of inventory and assets should be done. Bank reconciliation and other trial balance reconciliations should be done. Standard operating procedure documents should be made regarding process flow. Surprise check of petty cash and cash book balances. Checklist for accounting controls. While implementing accounting measures for control in an organization, learning the essential points to remember is crucial. Here is a checklist for the organizations to go through before they introduce the controls. Any change in one process impacts the other. Changes should not be made in the middle of an accounting period as they will affect the transaction flow. Auditors should be informed of any changes. Any change should also be documented and communicated well with all the stakeholders. It should be cost effective. Advantages. When controls are implemented in an organization, the workflow becomes more efficient as everything is organized and handled correctly. Below are some of the advantages of introducing accounting controls. Below are some of the advantages of accounting controls. In action, log identifies the person responsible for an error. Accuracy of financial statements and funds application. Efficient use of the resources for the intended purpose. Helpful in audit facilitation. A strong foundation for a more significant growth. Identification and rectification of any discrepancy identified. Saving cost and resources. Disadvantages. Despite having several advantages, implementing controls may have some limitations with organizations, which organizations must be aware of, as they may help them decide which controls to introduce. Below are some of the disadvantages of accounting controls. Sometimes irritating and time-consuming for employees. The high cost of maintaining controls and standards. Over-dependent on financial statements and audit. Duplication of work. I hope you like this video. If you have a business, this is the best way to have control over your business. Thank you very much for watching my video. Thank you. Bye for now. Please do not forget to subscribe to my channel. Thank you. Bye for now.